have risen by 7% from $220 million up to $236 million, which incidentally is slightly above our accounting EBITDA for oil of $223 million. In the appendices, there's plenty more details of these comparisons. So overall, during this half year, we've seen our second quarter GRMs increase over the first quarter GRMs by about 10%. And naturally, once phase one of oil completes and our complexity rises to 11.8, we expect to step up in GRMs overall. Before we finish, let us now have a look at the profit and loss account in a little bit more detail. We build up to our accounting EBITDA of $320.2 million for the first half of the year, from 99.1 contributed from power, 222 million contributed from refining and marketing, less net costs in the E&P and central costs of 1.8. Moving down below EBITDA, our depreciation has naturally increased as we have more assets being depreciated. Finance costs were up, partly due to the Algoma plant under operation, but also generally higher gross debt amounts. And although IPO proceeds were received, a good deal has already been invested in the business, and the remainder held in dollars temporarily, earning lower rates. Other non-operational gains of $63.2 million were mainly due to foreign exchange gains in the centre when converting sterling IPO proceeds to dollars. And our overall profit before tax was $154.4 million. Our tax decreased on lower profit before taxes and also a lower effective tax rate, which was down to 27.5% from 33.4%, and we expect that same effective tax rate to apply for the second half of 2010. $38 million of the $42.5 million of tax was due to deferred tax, and deferred tax is charged in our accounts in the customary way, as we have a timing benefit in terms of getting accelerated tax deductions on our CapEx programme, as our tax depreciation works off a reducing balance basis, whereas our accounts works off a straight line basis. So overall, profit after tax and before minority interests was $111.9 million for the half year. Finally, let us have a quick review of the cash flow and the capital structure. And this slide shows how our net debt has declined from $3 billion at the end of December 2009 down to $2.2 billion at the end of June 2010. Our gearing, when we expressed it as net debt divided by net debt plus equity, has declined from 59.8% to 33.1%. And of our $1.85 billion of net IPO proceeds, to date we've invested over $1.1 billion and advanced a further $225 million to oil as a trade credit, which will return when power needs it later in the year. And this trade credit helps reduce our group finance costs overall, whilst it is being waited to be deployed in power. I'll now pass over to Naresh for a review of operations.
Thank you, Jerry. Good morning, everyone. I would like to take you through the operating performance of the business and then focus on the progress with our growth projects. In power, all four of our operating assets put in a solid operating performance, including a full period contribution from Algoma Power that was commissioned in June 2009. Plant availability factor was above 94% from each of our plant. As a result, we saw increased revenues from availability-based tariffs, notwithstanding lower demand from the state of Gujarat in our Bhandar power station. Bhandar Power did, however, benefit from an increased tariff from April 2010. Our safety record was also positive across the portfolio with zero lost time incidents. We processed 7.28 million tonnes of crude during the first 6 months of the year, our highest throughput to date, reflecting a capacity utilization rate of 128%. And we continue with our excellent safety record, again with the zero lost time in the refinery sector. More than 20 types of the crude were processed during the period, including our first parcels of indigenous Mangla crude, which has shown good results. Our focus continues to be to optimize the mix of crude by increasing the share of ultra-heavy crudes. Our focus is also on maximizing high-margin middle light distillates. Our heavy distillate production includes bitumen. Bitumen is a growing market in India, and this segment of the market in India is enjoying higher margins as compared to other heavy distillates. We currently have a 14% share in the bitumen market in India. With a view to maximize our margins through an optimized sales mix, our focus continues to be on domestic market, where we sold over 70% of our production. I would now like to spend a few minutes talking about our growth projects. Today we are investing more than $11 billion in the projects that are either under construction or advanced stages of development. Each project is shown as a bubble on this diagram, with the arrow pointing to the timeline showing the date of commissioning. The size of the bubble relates to the capital cost, and those with the bold line around the outside are under construction. At the top we have the greenfield projects and below brownfield projects. Most of these projects are significantly de-risked through fuel supply, offtake arrangement, or EPC, and we have in place all of the equity for those projects and much of the debt. Now I would like to update you regarding progress on our major projects, starting with power. The Vadinar Phase 1 power project is now entering the final stages of commissioning, and the first gas turbine has run on bearing for a 45-minute test. We expect this project to enter the commercial operation as planned during this quarter. The project is running to schedule and budget. You can see from this picture that all major equipment erection works are completed for both GT1 and GT2. Slaya is also making significant progress and is now 66% complete and should come online in the second quarter of 2011 as planned and within budget. Again, these pictures show some of the site progress. You can see the chimney and the boiler erection progressing and other units under construction. Mahan, another of our large coal-fired projects, is now 55% complete, and last month we completed the first heavy lift for the first boiler drum. We expect this project to commission in the third quarter of next year and is running in line with budget. This picture gives a good overview of the site. You can see the chimney on the right-hand side, and then moving to the left, you can see the boiler construction, turbine generator, transformer, and the switchyard. This has a very similar layout to the Slaya plant, where we have sought to modularize our plant to reduce cost and to manage risk better. Our other Phase 1 projects are also making significant progress, as shown in this slide. I won't go into each project in detail, but I would like to point out that we have now tied up financing for all our projects of Phase 1 and Phase 2, with exception of Nabharat 1 and Mahan 2, both of which need to secure fuel before we can complete their financing. I should also note that our transmission project is running behind schedule. However, we are prioritizing our work so that we will not be impact our ability to evacuate power to our customers. All other projects are running on schedule. We're also making significant progress with our Phase 2 projects, including Nabharat Power, where in July we signed a share purchase agreement to acquire the balance of the Nabharat Power. At the same time, we have also received a financing sanction letter of $800 million for the entire debt financing for Phase 1 of the project. Nabharat Power is a 2,250 megawatt coal-fired power plant